Welcome to another explainer from us here at ProTax Accountant. So you've built something great and you want to pass that wealth on to your kids, but you're not quite ready to hand over the keys to the kingdom. What if I told you there's a way? Today we're going to dive into a really powerful tool called the Family Investment Company. I mean, it really is the classic dilemma, isn't it? You've spent years, maybe decades, pouring your heart and soul into your business. You want to help your kids out, give them a real head start in life, but just writing a massive check, it feels a bit unsettling. You're giving away control. So the big question is, can you give them the financial benefit without giving up the driver's seat? Okay, so here's our game plan for today. First, we're going to break down what we call the gifting dilemma. Then we'll introduce the solution we're here to talk about, the Family Investment Company, or FIC for short. We'll get into the nuts and bolts of how they actually work, compare them to the alternatives, and, this is really important, we're going to have a serious reality check on the risks and what each MRC thinks about them. By the end of this, you should have a really solid idea of whether an FIC could be the right strategy for your family.
Right then, let's dive in. Let's start with the most obvious approach, the traditional way of passing on wealth. You just give it away. Direct gifting. It sounds so simple, right? But the truth is, for a lot of UK business owners, contractors, and SMEs, it's a path that is absolutely riddled with pitfalls you might not see coming.
So let's make this real. Meet David. David has spent the last 30 years building a fantastic engineering firm from scratch. His kids are at that age where they're looking to buy their first homes, and naturally, he wants to help them with the deposit. The easy answer would be to just, write a big check. But he's hesitating, and it's for some very good reasons that go way beyond just the money itself. So this is what's going through David's mind. The second he makes that gift, he loses all control. It's their money, not his. He has no say in how it's spent. Then there's inheritance tax. If he dies within 7 years of making the gift, that money could get hit with a whopping 40% tax bill. It's not a clean break. And what about life's curveballs? Say one of his kids gets divorced. Well, that generous gift he made could suddenly be considered a matrimonial asset up for grabs. And there's this other really tricky trap called the gift with reservation of benefit. Basically, if you give an asset away but keep enjoying the benefit, like giving your house to your kids but continuing to live there rent-free, HMRC will just turn around and say, nope, you haven't really given it away at all, and it'll stay in your estate for tax purposes. It's a minefield. Okay, so if just giving money away is such a minefield, there has to be a better way, right? A more modern, a more strategic approach to this? Well, there is, and that's what we're here to discuss. The Family Investment Company. So what exactly is a Family Investment Company, or FIC? Well, you can think of it as your own bespoke, private company set up specifically to hold and manage your family's assets. The real genius behind it is how it neatly separates two key things: control of the assets and the economic benefit from them. The analogy I like to use is a car. With an FIC, you, the parent, get to keep the keys, the steering wheel, and the pedals. You're in complete control. But your children, they get to benefit from the journey. They get the value. It's a brilliant way to structure things. And you might be thinking, this sounds like some super complex structure reserved for billionaires. But here's a fun fact. It's not. There are already more than 10,000 FUICs registered right here in the UK, and that number is climbing fast. And the reason is simple. High net worth families, business owners, people just like you are actively looking for smarter, more robust ways to plan for their family's future. Okay, so let's get into the mechanics of this. How does an FIC actually let you give wealth away while you stay firmly in the driver's seat? It's all about how the company is structured from the very beginning. It's incredibly clever. No, first things first, setting up an FIC is absolutely not a do-it-yourself weekend project. It's a very precise legal and financial process that has to be guided by professional advisors. You'll incorporate a new company, fund it with cash or assets, but step 3 is the crucial one: structuring the shares. This is the secret sauce. You create different types of shares, and this is what allows you to separate that control from the value. And here's how that share structure works. It's brilliant, really. The parents, the founders, hold what are often called freezer shares. Just like the name suggests, their value is frozen at the amount you initially put in. But, and this is the key part, these shares hold all the voting rights. All of them. This means you control every decision. And for inheritance tax planning, this is fantastic because it caps the value of your IHT exposure. Now, your children get what are called growth shares. These typically have no voting rights at all, but they are entitled to all the future growth in the company's assets. So as the investments in the company grow over time, All of that appreciation in value belongs to the next generation, completely outside of your estate for IHT purposes. It's a really elegant solution. Okay, that's the FIC, but you're probably thinking, hang on, what about a trust? Isn't that the traditional way to do this? That's a great question. So let's put the FIC and the discretionary trust side by side and see how they stack up. The differences are pretty stark. Just look at this table. The numbers really speak for themselves. The biggest one is the IHT charge when you set it up. If you gift more than £325,000 into a discretionary trust, you're hit with an immediate 20% tax charge. With an FIC, because it's structured as a potentially exempt transfer, that upfront charge is zero, nothing. Then you've got ongoing IHT charges. Trusts face a charge of up to 6% every single decade. FICs? None. And look at the tax on income. An FIC pays corporation tax, which is currently 25%. A trust? It's taxed at a massive 45% for most income. The parents retain direct control as directors in an FIC, whereas in a trust, you pass that control to trustees. The one area where a trust wins is privacy. They are private, whereas an FIC is a registered company, so its details are public on Companies House. But for many, the tax efficiency more than makes up for that. So, FICs are clearly very powerful. But let's hit the pause button for a second, because we need a reality check. This is not a set-it-and-forget-it solution. There are significant risks, there are compliance burdens, and you better believe that HMRC is paying very close attention. You know, HMRC actually established a specialist unit specifically to scrutinize family investment companies. Now, the good news is they concluded there was no systemic abuse. But the very fact they created that unit tells you everything you need to know. They are monitoring them. The bottom line is, an FIC, when structured and run correctly for genuine family and commercial reasons, is perfectly legal. But if you try to use it for artificial or aggressive tax avoidance, you are going to draw some very unwanted attention. And probably the most important rule to understand is something called the settlements legislation. Let me be crystal clear about this. You cannot use an FIC to divert dividend income to your children who are under 18 to try and use up their personal tax allowances. These anti-avoidance rules are rock solid. If a parent sets up this kind of structure and their minor child gets dividends, that income is simply taxed as if the parent received it. End of story. It just doesn't work. And this isn't just my interpretation. Here is a direct quote from the government's own website. HMRC's view is that these schemes do not work. They're specifically talking about schemes that try to fund things like school fees through dividend diversion. The message from the taxman could not be any clearer. Don't even think about it. And there are other key risks you've got to factor in. First, there's the potential for double taxation. The company pays corporation tax on its profits, and then when you distribute those profits as dividends, the shareholders pay income tax on them. There's also the administrative burden. We're talking annual accounts, tax returns, proper board meetings. It's a real company. And a crucial point on asset protection. While they offer some protection, the shares in an FSIC are still very likely to be considered matrimonial assets in the event of a divorce. They are not a magical fortress. So here's a professional tip for you. Your absolute best defense against any scrutiny from HMRC is meticulous record keeping. I mean everything. Board minutes detailing your decisions, proper loan agreements, records of why dividends were declared. A clear, comprehensive paper trail that shows the genuine family governance and commercial purpose of the company is absolutely critical. All right, so we've weighed the really significant benefits of an FIC against some pretty serious risks and responsibilities. Which brings us to the final and most important question. Is a family investment company actually the right move for you? Well, as a general rule of thumb, most professional advisors would suggest that FICs really come into their own for families with investable assets of over £2 million. Now, why that specific figure? It's really about balancing the costs versus the benefits. The legal and accounting fees to set up and run an FIC properly can be quite substantial. Below that £2 million level, there's a risk that the ongoing costs could start to outweigh the tax advantages you're hoping to gain. Okay, let's just quickly summarize the key takeaways here. FICs are a brilliant tool for maintaining control over assets while passing future growth to your children in a very tax-efficient way. When you compare them to large gifts or trusts for IHT planning, they're often significantly better. But, and this is a big but, they are not a DIY solution. They demand expert legal and tax advice, strict adherence to anti-avoidance rules, and proper documented governance. So, the final thought is this. Could a family investment company be the key to securing your family's financial future for generations to come? For the right family with the right circumstances and the right advice, the answer is absolutely yes. But every family situation is unique. What we've done today is give you a general overview. To find out if it's the right move for you, professional advice is essential before you take any action. If you're considering whether an FIC could be a part of your family's financial strategy, please do get in touch with us here at Pro Tax Accountant for a tailored professional consultation. And of course, if you found this explainer useful, don't forget to subscribe to our YouTube channel for more clear, concise breakdowns of complex tax topics. Thanks for watching.